The last time we started on the paper that will be continuing with today, and last week we managed to cover questions that had to do with the ratio analysis. So our main areas that we covered were on ratio analysis. So today we want to cover on another part, right? So if we can check here, we managed to answer the whole of question 1. So now let's deal with the question 2. Let's deal with question 2 today. Right. Question 2 has got 2 parts, so try by all means to. I think there's a. Let me just meet you guys. You. Right, we'll try by all means to make sure that we finish these 2 parts. Right, Lambo Limited wishes to install automated inventory monitoring handling equipment at a cost of 2.4 million. This will result in an improvement in the supply chain process. This is expected to result in before tax annual savings of 900,000 for 6 years. It's very important to know whether it's before tax or after tax, because when they say before tax, that means they've not yet taken into account the tax expense. Right. If they say it's before, that means they've not yet taken the expense into account. If they say after, that means it has already been taken into account. Right, the expected residual value in 6 years' time is expected to be 0 due to the unexpected advances in technology. Due to expected advances in technology, SARS will allow the company to depreciate the equipment on a straight line basis over 6 years. The company's cost of capital is 12%, and the corporate tax rate is 28%. So they want us to calculate the NPV of the equipment using the net present value method. Then we'll also calculate the IRR of the investment using the financial calculator, clearly showing all inputs into the calculator. Right. So now let's do question 2. We're going to have to provide a column for each year. Right. So we're going to have we'll have our year. We'll start from year 0. Up to year 6. Right. Right. Then we record our cash flows. We're told that they wish to install automated inventory monitoring and handling equipment at a cost of 2.4 million. That means the initial investment is 2.4 million. So we'll have our initial investment. Right. we'll put it as a negative. That's negative 2,400,000. Right. Then we'll then look at the changes, the inflows and outflows that are expected from the investment during the periods. Right. We'll have we are told that this is expected to result in before tax annual savings of 900,000. So annual savings now we're told that the annual savings will start on year one. The annual savings will start on year one. So that will be 900,000. These are savings. So that will be an inflow. So we'll put it as positive. Right. But remember that they are before tax. So we have to take into account the income tax rate. So we'll have our income tax rate. For us to determine our income tax, we have to do a calculation. Right. We're going to have right. So we have our year 1, 2, 3, 4, 5, 6. Right. We'll have our annual savings. $900,000. Right. But for tax purposes now, SARS will deduct what they call wear and tear. And we are told that the wear and tear, according to SARS, SARS allowed the company to depreciate the equipment on a straight line basis over 6 years. So it will be the cost divided by 6. So that will be 2.4 million divided by 6. Right. So we're going to get 600,000. Since everything is the same in an exam scenario, you can just make it a calculation for all of the years at one time. Oh, 400,000. Thank you. Not 6. Right. Then we get our taxable income. Which is equal to this. Then we get our income tax at, what did they say is the tax rate? Especially in your exams, please check, because sometimes these days they are now using the new rate, the 27. So they said 28. So use that 28%. So we find our tax. Thank you. 140,000. right? So this would be 140,000 for all the years. It's not always the same. And if they are the same like this, you are allowed in the exam to just do one calculation, then you say year 1 to year 6. Right. Then our tax here, it will come here. And it will be subtracted because you'll be paying SARS. Right. After recording all your cash flows, then you find what we call the net cash flow, cash inflow or outflow. If it's an outflow, net cash outflow if it's negative, and it's a net cash inflow if it's positive. Right. So we'd say we add up each year. Right. Then we find our discount rate. We're told now that our discount rate is the cost of capital is 12%. So we'll find our discount factor at 12%. Right. For year 1, it is always equal to 1. Right. Then for year 0, it's always equal to 1. For year 1 going up to year 6, you check on your tables. You always be given tables. So you go on table A. Then you go under 12%. Then you check these ones here. From year 1 up to year 6. Those are the rates that you're going to check. So you check the ones that that give you the that are under the rate that you are given on table A. So whenever you're finding the net present value, you use table A. But remember that for year 0, the discount factor is always 1. So the one that you get on your table will start from year 1. So we'll have 0.893. We'll have 0.797. We'll have 0.712. We'll have 0.636. We'll have 0.567. We'll have 0.507. Right. The meaning of this is that a 1 rand that we receive after year 1 is equivalent to 89 cents today. 1 rand that we receive after year 2 is equivalent to 79 cents today, on and on. Right. Then you find what we call our present value. Right. To get your present value of the cash flow, you multiply your cash flow times the discount rate, your cash flow times the discount rate, your cash flow times the discount rate. So each year's cash flow will be multiplied by the discount rate. So we would say the 2.4 multiplied by 1. Then for year 1, it will be the 760 multiplied by 0.893. For year 2, it will be the 760 multiplied by 0.97, on and on like that. So we're going to get the present value of each year. That means this 760,000 that we get after year 1 is equivalent to 678,680 today, based on the cost of capital. Right. Then you find your net present value. To get your net present value, you add up the present values. To get your net present value, you add up these net present values, the present values. So that will be equal to the sum so that will be our net present value. Right. Do we have any questions there? They can also ask for a comment. Did they just say calculate? You should read the question. Or they can say calculate and comment maybe that should they go on with the project and stuff like that. If they just calculate using the net present value, they just said calculate. But if they said comment also, we're going to say they should invest in the project because it gives a positive net present value. So as long as your net present value is positive, then you can go on and invest in the project. But if it has got a negative net present value, then you don't go on and invest in the project. All right, if you don't have any questions, we'll go to part B. Part B says calculate the IRR of the investment using your financial calculator. Right, now to get your IRR, let me just indicate here that this was the net present value. Which is the internal rate of return. Now to get your IRR, you need these cash flows here before discounting, these ones. So here, since the cash flows are the same, there are two ways that you can do it. You can, okay, you can say your cash flow 0 is equal to negative 2.4 million. Your cash flow 1 to 6 is equal to 760,000. Then you find your IRR. It will depend with your financial calculator. If you are using the Sharp, first of all, you have to put the cash flows one by one. That means you negative 2.4 input, 760,000 input, 760,000 input 6 times. After that, you have to go to your second function, the one with the cash. Then you say down arrow, then compute. So whatever you do there is what you are going to write. If you are using the HP, you just enter. After finishing, then you say second function with the button that is got the IRR. Then that's it. So that's what you just write. So that means our IRR, okay, we can say negative 2. Okay, I can just calculate it from there. I've used Excel here. We get 22.12. So you can try it using your financial calculator. So that's 22.12%. That is our IRR. So it all depends with the calculator that you are using. Any questions? Right, we go to the next one. Part 2. Masti Suppliers is a company involved in the transport of produce from Free State to Johannesburg metropolitan area. The company is evaluating the purchase of 2 new refrigerated trucks, which are expected to be more economical than 2 of the current trucks due to advances in the refrigeration technology and improved. Yes, but it takes time. You have to calculate, it's the trial and error thing. You have to calculate the NPV. Then you find one that gives you a positive and one that gives you a negative. Then you find the interpolation. So you have to calculate 2 NPVs, one positive, one negative, and it will be trial and error. So you find that it can be done. But normally in your exams, they will tell you that calculate the NPV. Let's say like this one, it was 22%. They can say calculate the NPV at 20%, calculate the NPV at 24%. Then you interpolate. I think we've done interpolation before. Right. Then the company expects to achieve the increase in before tax earnings of 432,000 per year. This is made up as follows: cash flow savings of 222 per year, and cash reduction in claims of 180,000 per year, as well as reduction of fixed costs of 30,000 per year. In analysis of the fixed cost indicates an increase in annual accounting depreciation of 120,000 and a reduction of cash fixed costs of 150,000 per year, which results in net reduction of 30,000 per year. The claims arise from not meeting quality variations in product temperatures. The total of the two new trucks is to 1.2 million. The current trucks, which have a tax value of 0, can be sold for 150,000 each. The future residual value for the existing trucks is expected to be 0 in 5 years' time. The residual value of the new trucks in 5 years' time is expected to be 300,000. The company's cost of capital is 14% and company tax rate is 28%. The tax effects on the sale of the existing trucks will occur at the same time as the sale. Right. So now, they want us to determine what are the incremental cash flows per year. Right. So let's say calculation of incremental cash flows per year. Right. We are told that there is, so we're just adding up these things that were given. There is cash fuel savings of 222,000. So we have cash fuel savings. If it's a saving, it's positive. 222,000. Right. Then we have cash reduction in claims, 180,000. That's a saving again. Right. $180,000. Then the fixed cost is made up of two things. It's given here, down here. So let's read where it's given. In analysis of the fixed cost indicates an increase in depreciation of 120. Depreciation is a non-cash item. So when we're looking at cash flows, we don't include depreciation. We don't include depreciation when determining cash flows. And a reduction of cash fixed cost of 150,000. So there's a reduction in cash fixed cost. $150,000. So this will give us our incremental cash flows per year. The other things are not annual items. So that's why I didn't include them here. So when you're calculating your incremental cash flows you per year, you are looking at those cash flows that happen yearly. So that's 552,000. Any questions? Okay, if we don't have any questions, then I'll move on to the next one. The next one says, determine the NPV of the investment in the two trucks using the net present value method. So let's say number B. Calculation of net present value. Right. We have our year. It's 5 years, 0, 1, 2, 3, 4, 5. Right. Then we are told we'll start from the beginning. We've got this, the first paragraph talks about incremental cash flows. So we can have our incremental cash flows. Which are the ones that we calculated on part A. And remember, they start in year 1. They will start in year 1, not in year 0. Right. So we'll have every year for 5 years. 152,000. Right. Then we'll have the claims arise from not meeting quality. Okay, I think I've read all this up to here. So we'll start from here. The total cost of the 2 new trucks is 1.2 million. So initial investment is 1.2 million. And it's negative because they will be pumping out money. So always remember that the initial investment, and sometimes they can also give you working capital. We're supposed to show them as negative. Right. Right. And then next, the current trucks which have a tax value of 0, that means they have a 0 value, will be sold for 150. So sale of what? Current trucks. Which is 150,000 each. It's money coming in, so we'll put it as a positive. Then the future residual value of the existing trucks is expected to be 0 in 5 years' time. So there's no residual value. The residual value of the new trucks in 5 years' time is expected to be 300,000. So they have residual value of new trucks. When they say residual value, that is the price amount at which we can sell them at the end of their useful life. So we can say what? 300,000. Then the company's cost of capital is 14% and corporate tax is 28%. The tax effects on the sale of the existing trucks will occur at the same time as the trucks. Right. Then we would calculate our income tax expense. Calculation of income tax expense. Right. Right. We have incremental cash flows. right? And you can see that this time around, I've included year 0 in our calculation. This time around, I've included year 0 in our calculation. I will show you why. I will show you why. Right. Why did I include the year 0? It's because here we're told that the tax effects on the sale of the existing trucks will occur at the same time as the sale. The sale is happening at year 0, so the tax effects will happen at the same time, so they will also happen at year 0. That's the reason why I've included that. Right. So then there will be recoupment on sale of new trucks, sale of current trucks. Right. Remember, they said that recoupment is just like profit on sale, what we call a profit on sale in accounting. These trucks, we are told that they've got they've tax values of 0. That means their value is 0. So if they are sold at 150,000 each, that means they will be so. Oh, I think we made a mistake. They said 150,000 each. So please, here I have to correct here. Can I correct here and include 150,000 times 2? So this is 300,000. Was it what 150,000 each? Right. Their tax value is 0. So because their tax value is 0, that means the whole 300,000 will be what we call recoupment. So as the profit, they call it recoupment. So we have a recoupment on new trucks. Oh, sorry, I've already returned that. That will be 300,000. Considering that they said it will also happen at the same time as the sale of the trucks. Right. Then we are going to have the new trucks. It will be 300,000 each again. So let's also go and correct this one here and say 300,000 times 2. So this is 600,000. Right. So here the recoupment of on sale of current trucks, it will be 600,000 also. Why? Because they will have been fully provided for in terms of the capital allowance. But if, for example, you sell your asset when the tax value, for example, let's say if these assets had a tax value of 200,000, to get your recoupment, you're going to say the selling price minus the 200,000. But considering that all these vehicles will be sold when their value is 0, the full amount will be regarded as a recoupment. Right. So then we'll be able to get our taxable income. Which is equal to the sum that will be our taxable income. Then we get our income tax expense. At 28%. So I would say equal to So that will be our income tax. Thank you. Right. So here that income tax expense will then import it to our so it will be okay, sorry. And here it will be subtracted. Would say right. Would say our net cash right. Net cash inflow or outflow. Right. We get right. Then we'll get our discount factor that we're told that the cost of capital is 14%. So use 14%. Then we go to your tables. Remember that for year 0 is always 1. Then for year 1 up to 6, you go to your tables. So the 14% is here. You always use your table A. Then you take these 5. So say 0.877, 0.769, 0.675, 0.592, then 0.519. Right. Then we get our present value. Right, which we find by multiplying our net cash flow multiplied by our discount factor. These will be our present values. Remember, I told you the meaning that it just means this net 397 in year 1 is worth 348 now. The 829 in year 5 is worth 430 now. Is that right? So then we get our net present value. The net present value, you add up your present values. Right, so this is equal to the sum of our net present values. So that would be our net present value. Then, as I said before, you also have to check, did they require you to comment on the acceptability or lack of acceptability of a net present value or a project. So you're supposed to check if they also want you to what? To comment. Right. So we're going to say right here we're told they just said determine. They didn't say anything about commenting. But if they said comment, we're going to say accept buy the new tracks because that will result in a positive net present value. Any questions there? No questions. Okay, if we don't have any questions, then we'll move on. Right. Then the next question, it says, calculate the IRR using the financial calculator. So it's the same like what we did the other time. So we're going to say when you're calculating the IRR, I use these undiscounted cash flows before you discounted these net cash flows. So your input would be cash flow 0 is equal to negative 984,000. Cash flow 1 to 4 is equal to 397. 440. Cash flow 5 is equal to 829. 440. Then you determine your IRR. Would be equal to, right, we can just say equal to IRR that means 34.73%. And the IRR will be acceptable as long as it is more than the cost of capital. The IRR will be acceptable as long as it is more than the cost of capital. Like in this case, if you can check, our cost of capital is 14% and our IRR is 34.73. That means at the end of the day, we can say the project can be accepted because it's likely to increase the value of the entity. Because when a project has got a positive NPV, that means that's the value in present monetary terms that it can add to the entity. Right. Any questions there? No questions. Right. I thought I was going to look at the other question, but now I have to start another class. So can you please also try to do the other question 3? Because I definitely know that you face questions on the cost of capital and stuff like that. You can use what we did in our classes to try to do it. So I wish you all the best, and I know that you will make it. May God guide you to give you remembrance of whatever we've done, and may you be successful tomorrow. Thank you so much, and God bless you richly.
Thanks a lot, Eugene. Thanks.
Thank you. Thank you.